Hi everyone, and welcome to Smith & Williamson's budget webinar on business taxes. My name's Amy Jack, and I'm joined by various colleagues this morning who will take us through the impact of the budget on their respective areas. First, you'll hear from Alexandra Bray on corporate taxes. After that, we have David Williams on employment taxes, and finally, John Rainsford on VAT. You will see a few polls popping up on your screens throughout the webinar. Please do take part and we'll comment on the results as we go through. Please also submit any questions you have as we go along. We should have a few minutes at the end to go through as many as we can, and you can submit questions through the question and answer box that you should see at the bottom of your screens. As to our overall views of the budget, we thought the most notable thing was how little of it there actually was. This wasn't totally unexpected, given we have less than 6 months until the UK is scheduled to leave the EU. So attentions are clearly focused on that instead. The most interesting thing was probably the digital services tax, but even that wasn't an unexpected move and seems to be fairly limited, both in terms of scope and the amount of tax it will generate. Philip Hammond did make it clear that if the UK leaves the EU without a deal, then it's likely the spring statement will be upgraded to a full budget, which means it might all change. So with that in mind, we will focus more on the changes that are immediately relevant. And I'll hand you over to Alexandra now, who will talk to you about corporate taxes.
Thank you, Amy. So probably the first thing to note in terms of corporation tax is that the government has kept to the roadmap to reduce the rate of corporation tax. It is currently 19%, as it has been since the 1st of April 2017, and it is still due to lower to 17% from the 1st of April 2020. Moving on then to capital allowances. So perhaps one of the most significant announcements likely to impact most businesses in the short term was announcements relating to a number of changes relating to tax depreciation on capital expenditure. Firstly, the annual investment allowance will be increased from £200,000 to £1 million over a 2-year period from the 1st of January 2019 to the 31st of December 2020. For those not familiar with the annual investment allowance, this is the amount of capital expenditure on certain qualifying items, broadly plant and machinery, which can be obtained as an in-year deduction in full. So there's a graph on the slide which shows how the annual investment allowance has changed over time. So it starts in 2008, and it shows, I suppose, that this is really relatively generous in recent history, and a clear move by the Chancellor to prompt investment, stimulate jobs in the economy. You can see from the graph that the last time there was a significant bump in this amount was 2014 to 2016, when it was at £500,000. So there will be a poll popping up on your screen, I think. We'll be interested to see whether this is something that businesses are factoring into their cash projections right now. There's also been the reintroduction of allowances relating to building expenditure with the introduction of the structural business allowance, which will provide a 2% capital allowance on the cost of any new non-residential structures and buildings. So this is equivalent to a 50-year straight-line writing down allowance for any contracts entered into after the budget date of the 29th of October. It's worth noting as well that the allowance is only available once the building is in qualifying use and within 7 years of incurring the expenditure. Qualifying use is seen through the eyes of the occupier of the building, so there must be a physical occupation. There won't be any balancing allowances on disposal, and the new purchaser of any building claiming the SBA will be able to continue claiming the SBA. SCAs previously claimed by the disposing party will be effectively clawed back by an adjustment to the tax base upon disposal. A positive thing is that renovations or conversions of existing buildings will qualify. And the main exclusion is really on dwellings, which will not qualify. We don't yet have a full definition of what dwellings will mean for the purposes of these rules, and it can be a disputed term, but we are aware that it is not envisaged to be the same meaning as for plant and machinery. So HMRC has said that hotels and care homes will qualify, but that if the building is intended for long-term dwellings, say university accommodation, that is not envisaged to apply. Likewise, communal areas that have a part residential, part business use, unlikely to qualify. The special rate of writing down allowances, on the other hand, is being reduced from 8% to 6%, and that's from April 2019. That is likely to have a negative impact on the net present cash value of existing balances, as well as to impact future expenditure, and will potentially be significant for businesses with a large proportion of long life assets or integral features in their capital pools. Finally, there have been some amendments to the enhanced capital allowances, and the government have taken away the ability to claim a full year deduction for certain energy efficient items. Then, as Amy said, it's hard not to mention the digital services tax. It's interesting to note that this isn't projected to raise a great deal in tax. It will raise slightly more than the soft drinks levy, and that's as currently projected. So it feels like a clear move by the government to show that it will continue to lead efforts with its partners in the EU, G20 and OECD on the BEPS agenda. It wishes to be seen at the forefront of that agenda, and this isn't the first time that we've seen the UK government take a unilateral stance, say with the introduction of the anti-hybrid rules and diverted profits tax, which are already in force. So this is actually not corporation tax, but rather a 2% tax on revenues, again not profits, of global digital companies, which will be enacted from April 2020. We don't have the detailed legislation yet, but the Chancellor has said that the scope should be quite narrow. This is only envisaged to apply to a small proportion of large global businesses that are profitable. So the business models which this is intended to apply to is search engines, social media platforms, and online marketplaces. It's important to say that it is not envisaged to be a tax on the online sale of goods, general online advertising, or the general collection of data. Furthermore, there are two financial thresholds which will further narrow the scope in terms of application of this tax to businesses. So global revenues from in-scope activities will only be within the rules if they reach at least 500 million a year, and even then the first 25 million of the relevant revenues are not taxable. There will also be a calculation introduced into the legislation, which is a mechanism by which companies that don't make very low profit margins or make losses on the revenues generated from this type of activity will either be subject to a reduced rate of the tax or not at all. The digital service tax will be an allowable expense under usual principles from your UK corporation tax bill. However, as it isn't corporation tax, it won't be within the scope of the UK's double tax treaties, and therefore it won't be creditable in full against UK corporation tax. This may give rise to a certain amount of double taxation for the revenues in question. So I suppose this is in line with BEPS Action 1 and the taxation of the digital economy. The OECD agenda has already gone some way to aligning profits with value-generating activities and identifying better which those value-generating activities are and where the people sit that undertake such activities. But there is a gap currently for the value, it's a very intangible value created by a network effect, a concentration of users in a given area. And I suppose this is clear to see in the remit of the areas of market that this is supposed to apply to, i.e. the search engines, social media platforms, online marketplaces. And it's shown there. You can see on the slide a little diagram taken from the HM Treasury website, and the people in the cloud using the devices and generating or increasing the value of the platform by doing so. So to take a few examples from the government policy document on this tax, if a social media platform generates revenues from targeting adverts at UK users, then the government will apply 30% tax to those revenues. If a marketplace generates commission by facilitating a transaction between UK users, then again the tax will apply to those revenues. If a search engine generates revenues from displaying advertising against the result of key search terms inputted by UK users, then the government will apply the tax to those revenues. Finally, on this point, the DST is going to be subject to a formal review in 2025, by which time I think the UK government are hoping that there will be an international measure introduced. If in the meantime a suitable international measure comes into force, then Mr. Hammond did say that this tax may be disregarded and we will adopt instead that international measure. Innovation was, Mr. Hammond said, a priority in the budget this year. Mr. Hammond said that he was committed to encouraging spend in technology and developments in innovative business areas. In line with this, we are seeing legislated two changes which have come out as a result of the consultation on the reform of the intangible fixed asset regime, which happened earlier in the year. Although the consultation covered a vast array of areas, for now we are just seeing two relatively small changes. The partial reinstatement of relief for acquired goodwill in business acquisitions from April 2019, and also the removal of the degrouping charge on intangible assets, where the disposal is one of a disposal of shares, and those shares would otherwise qualify for the substantial shareholding exemption. So that latter point simply bringing the treatment of intangibles in line with the treatment of tangible assets more closely. We are expecting the publication of the Finance Number 3 bill today, which will give more detail on these areas. It's interesting in particular to note the reinstatement of the relief for acquired goodwill. This relief was restricted in 2015 along with tax depreciation on customer relationships. We now have three types of treatment for intangible assets, being pre-2002, post-2002, and now post-2015 treatment. I'm interested to see whether or not this will go any way to clarifying those buckets or provide further complication, and indeed whether it will apply to purely the acquisition of a trade and assets or the acquisition of shares, whether there will be a mechanism to recognise the goodwill separately there. Perhaps it may seem on the flip side, there's been introduced a cap on the R&D tax credit for small and medium enterprises. This is to apply for accounting periods beginning on or after April 2020. However, it is worth noting that this is simply a cap, and a cap on the amount that the government will repay to loss-making companies. The expenditure that is not being repaid as a result of this cap can still be carried forward to offset against profits in future periods. In terms of the rules and what expenditure qualifies for the regime, that is not tightening or changing. The government said that this cap has been introduced to counteract perceived abuse of the regime and it is most likely to impact people using a lot of subcontracted R&D, given it is set at 3 times total PAYE and NICs. The HMRC are consulting with us as to whether or not the R&D credit works as it is supposed to with relation to subcontracted R&D. So we are inputting into how that legislation will develop. Finally, I will round up with a few other highlights from the corporate tax perspective. The carried forward capital loss relief will be restricted to 50% of capital gains going forward, with the 5 million allowance on capital or income losses. So this is applying similar principles as to the restriction on income losses, which has already been introduced. The UK government are legislating changes to the permanent establishment definition, which will give effect to the new definition in our double tax treaties, which is aimed at preventing businesses from artificially fragmenting or splitting up parts of their business into separate UK permanent establishments, each of which are preparatory or auxiliary in nature or don't form a PE in their own right, and avoiding forming a UK PE to which UK profits should be attributable by so doing. This will tighten that so that these activities will need to be considered in the whole in relation to whether or not there are profits to be attributed to a UK PE for UK corporation tax purposes. Corporate non-resident landlords are going to come within the charge to corporation tax from April 2020. This isn't new, but it is big for groups that have UK properties where the corporate landlord is a non-resident. This is because the entire company will now be disclosed through a corporation tax return to HMRC, and so it's perhaps a drive for greater transparency. This will also bring relevant companies within new taxes which haven't previously been applicable under the current non-resident landlord regime, such as the corporate criminal offence, corporate interest restriction, and anti-hybrids, which also relates to restriction on interest. These in particular may be relevant to such businesses as the UK property is often funded with debt. Finally, I would note that there have been some changes to the rules for approved EIS funds. Amy, your area of specialty, do you have anything to add?
Yeah, so the government is changing the rules for approved EIS funds. Currently, approved EIS funds can invest in any company, provided it qualifies under the EIS rules. But these new rules, which are due to be rolled out from April 2020, require approved EIS funds to invest 80% of their capital into knowledge-intensive companies. This announcement isn't a surprise, really, as the government has been trying to weight venture capital investment away from companies they perceive don't take enough risk and towards this type of company for a while now. The other change for approved EIS funds provides increased flexibility for fund managers through increasing the time period within which fund capital must be deployed. It will also be possible for investors to set their relief against income tax liabilities of the year before the fund closes. Under the current rules for approved funds, investors can often only claim income tax relief in the year in which the fund closes. This means generally there's limited benefit of an approved fund investment over a direct investment at the moment. So I wouldn't be surprised if this change ultimately led to an increase in the number of approved EIS funds. I'll also add that these announcements don't alter the rules for investing in a variety of EIS companies through a fund-type arrangement that's not approved, which is how the majority of EIS funds are currently organised. I'll hand you back to David now to talk about employment taxes.
Thank you, Alexandra and Amy. As has already been alluded to, it was a fairly quiet budget for employment taxes, with our expectation being that that's due to resource constraints at HMRC, with, we understand, large teams being transitioned to help with Brexit issues in the upcoming few months. The key announcements affecting employment taxes are all about topics that we've already been broadly aware of or were relating to consultations that had been closed recently before the budget, and in many cases the news has simply been that implementation has been delayed. On that topic, the biggest announcement is definitely the changes to the off-payroll work in the private sector. This will have a huge impact on all the businesses that are within its remit, but to be frank, the big news from this budget is that the changes have actually been put off and will not be implemented until April 2020, rather than the original April 2019 suggested implementation date. The change, as it is coming in, is an extension of rules which already apply in the public sector to private sector companies, and it will apply to any situation where your business pays a contractor or freelancer or a consultant, really anyone who works for your business but is not an employee, for services, and that engagement occurs through a company. Often these will be individuals' personal service companies, and it's particularly at this arrangement that this piece of legislation is targeted. At the moment, so long as your business contracts only with a company, a corporate body, or some other type of intermediary, and the payments you make are to a company or another corporate body, then you as the engager will never need to withhold PAYE or national insurance, provided the intermediary is in the UK. Once the new rules have come into force, engagers, so the entities like you ultimately paying for and receiving benefit of the work from contractors, will now have to take on the responsibility for conducting an employment status assessment for all of your contractors, and depending on the results of that employment status assessment, you will, in many cases or some cases, need to put that employee, that contractor, onto payroll and withhold PAYE and pay national insurance on all the payments made to that contractor. So this shifts all of the responsibility and risk that at the moment sits with personal service companies or other intermediaries for potentially having to pay PAYE and national insurance onto the engaging company businesses like yours. This will be a very significant change for all businesses that are within the scope of the rules. The possible exposure for PAYE will be tens of thousands of pounds for every contractor that your company engages. And so regardless of how big a business you are, multiplying that up by the number of contractors that you have is likely to end up with a very significant potential liability for you as a company. While this PAYE exposure isn't a cost for your business, it's a liability that you need to meet, and therefore penalties and interest on these amounts can potentially be an issue for you. What will be a direct cost to your business, rather than just an administrative change, is any national insurance costs that come with contractors who do need to be placed onto payroll. Finally, as well on this point, contractors who go onto payroll will see their net pay decrease because of the PAYE and national insurance deductions that they will suffer. And we've certainly seen in the public sector, where these rules are already in place, this has led to recruitment challenges for the public sector bodies, with contractors asking for increases in pay in order to compensate them for this. While the implementation of these rules has been put back to 2020, we would definitely recommend that businesses will need to prepare ahead. The contracts that this will affect are any contracts which run over the 6th of April 2020 date of implementation. So particularly 12-month contracts starting from April in 2019 will ultimately be affected by this measure, and so it will be necessary to assess those contracts and work out whether or not they're going to be affected ahead of time in order to avoid any nasty surprises for you as an engager, or indeed for your individual contractors come the 6th of April 2020. One piece of new information and a slight surprise is that we will be receiving an exemption for small companies from this measure. We've been given very little detail by the government on what this small company exemption will look like and just how small or in what way this cap will be defined. The only information given is that the 1.5 million smallest businesses are what HMRC are seeking to exclude using this measure. But we don't know whether this will be based on revenues, turnover, number of employees, or net assets, or any other measure. We simply don't know yet. There should be a poll about to appear on your screen now, which will hopefully get an idea for you of where you are in the process of looking at this situation, and we'll maybe come back to those results sometime at the end of the presentation if we have time. A final area where we're lacking detail on, as well as the small company exemption, is in relation to how these rules will work where there are multiple intermediaries in a chain. If there is just an engager, a personal service company, and a contractor, it's clear that the responsibility for PAYE and national insurance will fall on the engager. However, where there are multiple intermediaries, such as employment agencies, in the middle, it's not currently certain how this will apply. There is going to be a consultation in summer 2020 where hopefully the legislative details of this will be worked out. The other biggest change that has applied in this budget is in relation to so-called short-term business visitors. This is the terminology HMRC use for any non-UK tax resident individuals coming to the UK to work for your business for short periods. In this case, by short periods, what we mean is really anything up to a maximum of 6 months. You may or may not know, as a business, that any individual who comes to the UK and does substantive work for you in the UK, there is potentially a PAYE liability and payroll obligation under real-time information for you to place on that employee, even from the very first day that they arrive here in the UK. The way that this, what would be an absolute administrative nightmare, is dealt with by HMRC is that you can apply for what's known as an Appendix 4 short-term business visitor agreement, which means that rather than placing anyone who comes to the UK just for a single day onto payroll, you may need to put them into one of two buckets as to how they are dealt with. For individuals who are coming from treaty countries, so countries with which the UK has signed a double tax agreement, and the individual meets the requirements under the treaty to not have a UK tax liability, it is possible to simply report a bit of information to HMRC about the number of days those individuals have been in the UK and similar, rather than having any PAYE payments in relation to them. For individuals who are coming from non-treaty countries, or who don't meet the terms of a double tax treaty because of something to do with how they're paid or what their employment status is, there is instead a special PAYE arrangement that allows employers, rather than to pay monthly payroll with deductions every single month, to have one single yearly aggregate PAYE payment made at the end of the tax year. This is obviously much simpler administratively than doing monthly payroll for someone who may only be here for 1 or 2 days in 1 or 2 months. The changes that were announced in this budget all in fact relate to this special PAYE arrangement. The main difference is that there has been an increase in the number of days that someone coming to the UK and still be eligible for this special arrangement from 30 days up to 60 days. And that change will be effective from the 6th of April 2019. And the other thing that has made things a little bit administratively easier is that the deadline for making a payment of this single aggregated PAYE payment has been extended from the 22nd of April following the end of the tax year round to the 30th of May. It's disappointing that the government haven't made any changes directly in relation to visitors to the UK from overseas branches. This was a part of the consultation that has led to these changes, and we hoped that there might be a change in legislation that would allow visitors to the UK who are employed by an overseas branch of a UK company to be placed in that first bucket of individuals who only reporting is required but no PAYE payments. That change that we hoped to be introduced has not been introduced and has actually been actively rejected, and instead the government have said that they have relaxed and increased the scope of this special PAYE arrangement in order to cater particularly for visitors coming from branches. The final change that I'm going to highlight individually is the change to the rules regarding entrepreneurs relief, which may not on the face of it look like it is an impact on employers, but in fact will indirectly have an impact for employers because as you may or may not know, entrepreneurs relief is available on any shares acquired under an enterprise management incentive scheme, which has to be given to employees. Entrepreneurs relief is a 10% rate of capital gains tax rather than the usual 20% rate of capital gains tax on up to £10 million of certain qualifying gains. And the impact will be felt most for actual entrepreneurs, owners of businesses under this scheme. However, there is a knock-on effect to any employees who own EMI shares. The changes to the main entrepreneurs relief rules are an increase in the required holding period for the assets on which the gain is arising that someone is seeking to claim entrepreneurs relief, up from 1 year to 2 years, and some changes to the rules regarding the availability of entrepreneurs relief where somebody is selling shares. In particular, it's necessary for someone to be selling shares in a personal company in order to qualify for entrepreneurs relief in certain circumstances, and the definition of personal company has been tightened so that as well as requiring a 5% ordinary shareholding, certain voting rights and rights to capital and income are also required. How this follows through to affect EMI schemes is as follows. The 2-year ownership period will apply to shares acquired under EMI schemes, but there is a slight tweak to the way in which the rules work in that the starting point for the 2-year period of counting, the initial grant of the option under which the EMI share is later purchased, and then the end point is still the sale of the ultimate EMI share rather than just the ownership period of the share. The changes that apply in relation to personal companies simply don't apply for holders of EMI shares because the requirement to be selling shares in a personal company is waived for all holders of shares acquired under an EMI option. There are 2 other much smaller announcements that I will also briefly touch on. The first is a reduction, a narrowing of the scope, of the employment allowance. The employment allowance is a £3,000 reduction in your total employer's national insurance liability. This used to be available to all businesses regardless of size, and from 6th of April 2020, this will only become available for those employers whose national insurance bill in their previous tax year was less than £100,000. This impact will really not be that large for most employers who are affected because it's quite a small relief for those who will lose the relief, and those who benefit most from the relief will maintain access to it. There is also a confirmation of an intention to legislate on changes to the national insurance treatment of termination payments. Broadly speaking, we were very much already aware of this. We thought we might get the draft legislation announced immediately, but that's been put off until summer next year, we think. This measure will basically just bring into line the employer's national insurance treatment on termination payments with the tax treatment that already applies, so that the first £30,000 worth of a payment, of a termination payment, will be free from employer's national insurance, but any excess over £30,000 will be subject to employer's national insurance. The excess will remain exempt from employees' national insurance. These changes are only intended to be effective from the 6th of April 2020, which is what was already trailed. I'm now going to hand over to John to talk about the VAT developments from the budget.
Thanks, David. I'll spend the next 5 minutes or so talking about VAT. There are no major VAT surprises announced in the budget. Most of the changes relate to specific anti-avoidance provisions. But there are a few interesting points which I'll briefly cover. VAT registration. Although the VAT has the highest VAT registration threshold in the EU, which benefits the smallest businesses, the government recognises that the threshold can create a cliff edge and bunching effect for businesses choosing to remain below the threshold, which limits growth. A review of the registration threshold was carried out earlier this year, but didn't provide a clear best option reform, such as reducing the registration threshold or increasing it. This will be reviewed further, and as a holding position, the thresholds of £85,000 will remain unchanged until April 2022. As an aside, it is interesting to note that the 50% of unregistered businesses who took part in the survey reported that they had limited their turnover specifically to remain underneath the registration threshold. That briefing was confirmed that from April next year, non-corporate entities will be able to be members of a VAT group. The non-corporate members, such as individuals and partnerships, will be able to join the companies they are grouped with. These are welcome changes, as VAT grouping can have many benefits, such as easing cash flow and administration of VAT returns, as well as suppliers between members being free of VAT. Guidance will be amended. VAT groups will buy services from overseas branches to ensure that VAT is accounted for on suppliers where appropriate. Further details will be issued in due course. Moving to the next slide. Unfulfilled supplies. From March 2019, VAT will be due on all prepayments of goods and services, even where the underlying supply does not take place, unless the customer receives a refund. Under the current rules, some non-refundable deposits, such as where the hotel takes a deposit and the customer cancels the bookings, can be treated as non-VAT-free compensation. They mean that suppliers will need to account VAT on all forfeited deposits. As expected, in accordance with the EU legislation, from January next year, VAT treatment of vouchers will be amended. The aim is to simplify this classification of vouchers to make it clearer when VAT is due. The new rules refer to a single-purpose vouchers when the VAT treatment of the underlying supply is known when issued. These VAT will be due when the voucher is issued. So, for example, where vouchers are purchased from a retailer, which can only be used for standard rated supplies, VAT is due when the voucher is issued. For multi-purpose vouchers, where the VAT treatment of the underlying supplier is not known when issued, VAT will be due when the tie-in when redeemed for the goods or services. Insolvencies. From April 2020, the government will become a preferential creditor in business insolvencies, but only in respect of taxes collected by the business, such as VAT, PAYE, income tax and NIC. Whilst it's not welcomed by other creditors, It will reduce any distribution for them. At least it doesn't amount to return to before 2002, when HMRC was a preferred creditor for all assets. Move to the next slide, insurance. From March 2019, anti-voluntary rules will be introduced to restrict VAT recovery when offshore insurance intermediaries are used to provide services to UK individuals. Under the current rules, UK insurers can recover VAT on supplies made outside the scope of the EU. The change will mean that insurance providers will no longer be entitled to VAT recovery where the underlying contract is with the UK customer. It's not clear whether these provisions will also apply where the UK insurer and the offshore intermediary are not connected. Finally, construction services. On October 2019, a domestic reverse charge will apply for construction services, which will include alteration, repair, extension or demolition services. Under the reverse charge, the customer is responsible for account of VAT on the supplies received rather than the supplier. As suppliers will not charge and collect VAT, there is no risk to the VAT being undeclared. The reverse charge would only apply to customers in the construction industry and will not need to be ready when the new rules apply. In terms of the poll, when the Brexit results be ready, ask the following questions. How is your business potential changes to UK VAT rules as opposed as a result of Brexit? We are ready. We start to consider, unprepared and not concerned. I'd like to submit your position.
We might come back to this if we've got time at the end, if we get the results through in time.
Thank you to John, and thank you also to Alexandra and David. I'd conclude by saying that this was a very quiet budget, and attention was clearly diverted towards Brexit. There's a key takeaway point on capital allowances, as many of you will now want to review the timing of capital expenditure in order to benefit from the increased annual investment allowance. The changes to off-payroll working that David explained will also need considering. Although the introduction of those changes has been delayed a year, businesses will need to start thinking about how it will impact them now. I would also encourage you to visit our Budget 2018 website page, which contains our full analysis and insights, and the website details are on your screens now. As it was a very light budget this time round, it's likely we'll have a bumper budget at some point, possibly as soon as spring next year. Until then, it will be interesting to see what details await us in the finance bill that's being published today. We now have 15 minutes for questions, so thank you to those who submitted them. Our first question is, does the AIA cover the cost of mobile phones?
Yeah, okay, I'll answer that question. Thank you. Thank you for the question. Assuming that you've identified that mobile phones are capital expenditure in your business rather than revenue, which seems quite likely, then yes, there is no reason that the annual investment allowance should not apply to mobile phones. I would expect that to be in your general pool and covered by that allowance. The only thing I would add is that you should determine if there is any non-business proportion of usage of the mobile phone, as then you wouldn't normally claim capital allowances on the non-business element generally. Provided it's 100% for business use, yes.
Thanks, Alexandra. Our next question is on the IR35 changes. Do they only affect companies engaging contractors through personal service companies?
I'll answer that one. So no, the rules, the changes are effective for anyone who is engaging a contractor through any sort of intermediary, so a personal service company, through a partnership, through an employment agency. and the changes will be bringing in the obligation for the engager to conduct an employment status assessment and also to have the obligation to deal with PAYE or national insurance if it arises. However, I would just point out, if someone is engaging with individuals directly as a contractor, it's not subject to any of the changes, but those obligations already sit with you and your business. If you are engaging a contractor directly, not through an intermediary, you need to already be conducting an employment status assessment, and you're already at risk for PAYE and national insurance on payments to them. So no, the changes don't affect you, but it's that you're already caught by rules that apply already.
Thank you. Next question is, could the rules introduced for restriction of VAT recovery for insurance services supplied outside the EU be extended to other VAT-exempt services?
I don't think that's the case. There was concern the government was going to withdraw the specified supplies order, which allows VAT recovery on certain services, financial services, to be supplied to non-EU customers. However, the budget was very specific in targeting insurance to provide services to UK end customers. So I don't think that's the intention of the government to widen these provisions, which is good news.
So there are a couple of questions coming in, I think relating to the IR35 section and the off-payroll working in relation to contractors and whether they will be caught under the auto-enrolment and pensions, other pension requirements. I would say the answer to that is that there's no indication that that will be the case at all. I'd say we don't have draft legislation yet, so I can't say with certainty, but very much this measure is targeted very specifically at the tax, so PAYE and national insurance measures. And on a wider sense, we have had confirmation that at the moment there is no intention to make contractors who still remain self-employed for employment law purposes, even if they're having to be put onto payroll and treated like an employee for tax purposes. There is no indication, well, there is actually an express statement from the government that this doesn't grant them the employment status rights that you do have as an employee. I would, however, draw everyone's attention to the sort of developing area that is going on there. There are a lot of relatively high-profile cases with companies like Uber and Pimlico Plumbers and Deliveroo that have been going through where this sort of intermediate status of a worker who has some employment rights but not the full level of employment rights as an employee is being made applicable to lots of people who actually, even though from a tax perspective they're staying on the self-employed side of the line, so they're not needing to be subjected to PAYE and national insurance, they're gaining this worker status which gets them some rights. So the answer is, to go back to your direct question, the answer is no. We're not expecting someone who's a contractor who has to be placed on to payroll to need to be subject to auto-enrolment into a pension scheme. But look out for whether or not, if you've got someone who is having to be placed onto payroll, do look out for whether they might have either full employment status under employment law, because it is a slightly different test, or this intermediate worker status.
There's another question which I'll jump in with in relation to when will the structure and buildings allowance apply from. So yeah, that will apply from the budget date, the 29th of October 2018, for contracts entered into on or after that date. I should say that I believe there will be anti-avoidance provisions introduced as well to stop old contracts from being kind of artificially manipulated so that they will fall within the time period for the SBA.
Another employment taxes question, which is, if I pay someone from abroad to give a talk at a seminar, does PAYE apply on that single day's work? In that scenario, it would be very, very unlikely that that person would be regarded as an employee of your business in any way. That's going to be sort of akin to the contractor scenario that we've got here that we were talking about sort of separately. So PAYE isn't going to be applicable for that person coming from abroad, and that's because they're simply not integrated into your business in any way enough. So strictly, you would be saying that you're dealing with them as a contractor. They're not like an employee, and so they could be under these IR35 rules that we talked about. And so strictly, I guess you should really be conducting an employment status assessment. Someone who's coming for one day to do a talk at a seminar, that employment status assessment will very quickly return that that person's not deemed to be an employee, and therefore you don't need to do anything for your way.
Here's another question on are you aware of exemptions for domestic reverse charge for charitable housing associations? I don't think house associations need specifically excluded from the new rules. However, I suspect that the house associations will be excluded from the new rules as far as they're not actually involved in the construction industry trade. So I don't immediately see that they will be subject to the reverse charge rules because it's not a developer. Unless a house association becomes involved in developing property, then potentially it may be subject to the domestic reverse charge.
And there's another employment tax question, again about the off-payroll working. So I have mentioned these employment status tests, and someone's asked, what do you mean when you're saying employment status test? An employment status test is essentially applying the case law rules around when someone is deemed to be employed or self-employed for tax purposes to their situation. So you have to look at both the contract, the actual written wording of the contract that is applying, and also the practice, what is actually happening in real life when people are performing the contract. And you have to look at whether or not it has a number of different features laid out in case law as to whether or not someone would be regarded as an employee. The two first sort of the irreducible minimum, so the features that are absolutely required before you could possibly have an employment relationship are a mutuality of obligation, which has quite a complicated legal definition, and a requirement for personal service. So that is a requirement that that particular individual has to go and work on and provide the services that are being required. So a way in which people can avoid ending up being an employee under an employee status test is if there is a genuine right to substitution, so that someone could send along an alternative person, potentially requiring them to be suitably qualified, but an alternative to fulfill the role. However, with a note of caution on that, simply a note in a contract that says you can send along someone as a substitute, it will be always tested by HMRC, and there's a particular focus of HMRC's to make sure that a note in a contract is actually applicable in practice. Often we see this with sort of IT contractors, where they have a note in their contract that says they can send along a replacement, but in practice, if you're 6 months into implementing a project, it's simply not feasible for someone else to pick that up and do that, and that will get tested potentially by HMRC. If you've got those two aspects, the irreducible minimum, then you could have an employment relationship status, and there is then a long list of different factors that are looked at in a holistic approach to decide as to whether or not the overall picture is one of employment or self-employment. And just to be clear as well, just because you do have those top two factors, you can't be an employee without those top two factors. But if you do have them, that doesn't necessarily mean you are an employee. It just means you move on to the next bit of the test, which is looking at a big wide range of factors.
And there's another question in which I can answer on R&D. So which expenses, which PAYE expenses will the cap apply to? So we don't know yet. We haven't seen exactly what will be included in the 3 times PAYE and NIC cap. But if it follows the same as the previous cap that was in the regime, I think pre-2015, then it would be the amount during the period that is due to HMRC in terms of PAYE and NIC Class 1 contributions, excluding certain credits or working tax credits, child tax credits, and also disregarding deductions for statutory maternity and statutory sick leave, broadly speaking.
There's another employment taxes one, I'm afraid, sorry to keep talking at you. Someone's asked what I'm meaning by this branches point. Essentially, the issue is that when someone, this applies to a group where you have an employer, a main employer in the UK who has a place of business, some sort of office or body outside the UK, and outside the UK they might have some employees there. Any employees who are employed by that office outside the UK that isn't a separate legal entity, so it's just a branch or a permanent establishment or anything similar like that, they are deemed for the tests when you're doing this, looking at whether PAYE applies when they come to the UK, to be employed by a UK employer, because the head office of the company is in the UK and there's not a separate legal entity overseas. And basically what that means is that even though you might have a really big operation or something that's quite sizable overseas, you've got a French employee, as far as you're concerned, who only ever generally goes to work in France and their boss sits in France and does everything to do with France. But they come to the UK from day one, that they come to the UK to just sort of, even if they come to the UK just to meet a few people or work on a contract, one particular project for a week, that week of income that they receive is actually subject to PAYE. We were hoping that we would be able to get an exemption so that someone would be able to go under just treated under the short-term business visitor agreement and just given reporting requirements. But in fact, that's not been the case. HMRC have said, no, we still want our PAYE just for that 1 week. But you do at least now are able to, rather than put them on monthly payroll, you just have to pay the money in one hit at the end of the year.
That's all the questions we have time for, but if you'd like to discuss anything further, please do get in touch with Alexandra Gray on corporate taxes, David Williams on employment taxes, or John Rainsford on VAT. Thank you all for listening and for contributing to our webinar this morning. You can expect to present the recording and the slides in the next day or two. Details of our next few webinars are showing on your screens now. It would be lovely if you could join us for those too. Thanks again, and goodbye from us for now.